Well, hello. Welcome to the second quarter update of 2023. Seems like just yesterday I was doing the end of year quarterly video for the fourth quarter last year, and I told you that the market had had a top 10 bad year, and that statistically, that usually meant about an 80% chance markets would be up in the subsequent year, and statistically, somewhere in the mid teens. Well, we're kind of approaching all that as we speak. Now, I don't know if that'll continue. It's like most things, and I'll tell you why. So, the market started out recovering really in the tech area, and the tech area seemed to run pretty strong, and we were in the right areas and we kind of participated in that. And then the market broadened out and it's kind of spread across to, industrials and consumer staples, and it's just kind of broadened out across the market, which is a healthy sign, but it also tells me that there's not many bargains out there. People are looking at what do I buy next, and they're looking at pretty pricey things, and usually that leads people to make decisions to be more cautious and start taking some profits. I anticipate we may see some of that, as well as we've got a potential problem with UPS with the strike imminent potentially. If that happens, that's going to be very disruptive. We've got the Hollywood strike going on. That's very disruptive to the movie industry. So we have a few things developing while we have very strong employment. I mean, unemployment's very low. These things could turn the tide. And so I've been kind of waiting for an event like that. So I've got us really well diversified. So let me talk about that for a second. Diversification. I want to teach you a little bit about what that means, and it's the number one thing your advisor should do. I don't know anybody that says stick all my eggs in one basket. And you want to be diversified. You want to be in a position where you're participating in a lot of different things, but if something goes wrong, you're not going to lose everything because you were spread across many different things. Diversification is the number one rule. It's the first thing you need to do. You don't want to be all in one asset class. And so that means you should own other things besides stocks. And we do. We own real estate. We own stocks. We own bonds. We have cash. We have a lot of different things. But that also, in an up market, that drags on your performance because you've got all these different things that don't perform as well. But on a down market, you do better because once again, the thing that went down the most, you don't have all your money in that. So it's important to be diversified. And that's the first thing that I want you to understand when you're looking at rates of return. You have to look at, well, how was I diversified and what did I own? And I think that that is what's going to play a role in the next market move is diversification. We can now start to use fixed income products since interest rates have gone up so much. So it changes the dynamics of the investment markets and it complicates them, and it also makes them a little simpler in some ways. So bottom line is that we're having a good year. Things are good. We're well diversified. And let's just see how things play out. But I'm anticipating that I'll get an opportunity to get some bargains down the road. So until next time, you be safe.